We are now entering a critical moment in 2026. Trump's new tariffs are live, global supply chains are rattling, and the markets are already reacting. Inflation spikes, factories halt, and investors are asking one question: how bad will this get? Today, we're breaking down the Trade War 2.0 and why stocks, supply chains, and your wallet could all be on the line. The moment the tariffs were announced, industries across the globe went into immediate damage control mode. Electronics manufacturers in Taiwan, South Korea, and Japan scrambled to adjust their shipping schedules. Semiconductors, essential chips for everything from smartphones to automobiles, suddenly became the most sought-after items in global logistics as companies tried to beat the new duties. Automotive suppliers in Germany, Mexico, and Canada immediately started stockpiling critical components, ranging from specialized sensors to rare metals, knowing that any delay could halt production lines for weeks. Even consumer goods, the everyday items Americans rely on, were affected. Retailers were calling overseas suppliers, negotiating rush shipments, and recalculating prices before the ink on the tariff law was dry. The 2026 tariffs hit key imports across multiple categories: semiconductors, rare earth metals, finished electronics, and select consumer goods. The ripple effect was immediate. Ports in Los Angeles and New York saw congestion spikes, with container wait times increasing by 24 to 36 hours. Shipping costs, already volatile in the post-pandemic recovery, jumped 40 to 50% in some corridors within mere hours. European distribution hubs began adjusting pricing models as importers anticipated higher costs, and the domino effect reached Asia, where manufacturing centers adjusted production schedules to avoid bottlenecks. In the U.S., factories paused certain production lines, weighing the cost of paying the new tariffs against halting output. For companies relying on just-in-time manufacturing, this was a nightmare scenario. The supply chains that had been optimized for speed and efficiency now faced unprecedented uncertainty. Every single global market participant had to confront the same question: how high can import costs spike overnight, and how long can businesses absorb the pain before passing it to consumers? Electronics companies reported immediate sourcing crises, scrambling to find alternative suppliers as container slots became unavailable. Automakers warned that assembly lines could grind to a halt if essential components didn't arrive on time, and grocery, apparel, and electronics retailers quietly stockpiled inventory, anticipating weeks of delays. Every phone call, every shipment, every invoice carried an invisible tariff premium, the cost of doing business in this new trade war reality. This was not just a numbers game. The logistics nightmare became evident in real time. Ports were clogged with containers waiting for clearance. Freight brokers reported surges in demand that dwarfed even the 2021-2022 post-COVID shipping crisis. The cost of air freight jumped as desperate importers tried to bypass congested ports. The tariffs, initially framed as political leverage, were transforming into tangible supply chain shocks. Factories had to calculate the trade-off: pay the higher import cost or pause production, risking revenue loss and potential layoffs. And it was happening at global scale. As history has taught us, tariffs rarely remain a paper exercise. The 2018-2020 trade wars offer a clear lesson. When tariffs hit, companies inevitably pass costs to the end consumer, often faster than economic models predict. Grocery stores, electronics retailers, and clothing chains recalculated margins almost immediately. Inflation, which had seemed under control just days ago, was accelerating. Analysts warned that the bite would be felt in weeks, not months. For the average consumer, every dollar spent would now include hidden costs from duties they never anticipated. Investors were reacting simultaneously. Stock markets fluctuated with increased volatility, futures swinging wildly, hedge funds repositioning, and institutional investors seeking safe havens in precious metals, bonds, and dollar-denominated assets. The Dow, Nasdaq, and S&P futures became a daily roller coaster, reflecting the uncertainty in both supply chains and consumer prices. The real question facing market participants was no longer, how much will inflation rise? But, when and how will the full ripple of costs hit every link in the supply chain? Factories could delay production, ports could experience unprecedented congestion, and the stock market could continue to gyrate violently, with some sectors experiencing catastrophic exposure, while others remained relatively insulated. And here comes the psychological factor. Companies were operating in panic mode. Electronics firms, relying on semiconductor supply, faced production risks for millions of devices. Automakers worried about shutting down multi-billion-dollar assembly lines. Consumer goods companies reevaluated profit margins daily, some quietly stockpiling essential goods to avoid total production halts. For retailers, the moment tariffs hit, they had to make hard choices: raise prices, absorb costs, or halt shipments. Each decision carried consequences not only for profit margins but also for long-term brand trust. We now enter the mechanics of the tariffs' impact. Shipping lanes are under extraordinary pressure. Vessel availability is constrained, costs skyrocketing. The just-in-time philosophy, which had dominated supply chains for decades, now collapses under the weight of unpredictability. Companies must diversify suppliers, expand storage capacity, and anticipate future disruption, actions that add immediate costs and strategic headaches. Ports across the U.S. are experiencing backlogs, while Asian factories adjust lead times and labor allocations to accommodate volatile shipments. Let's turn to consumer inflation. The ripple from tariffs to prices is never linear. A $100 import duty on a semiconductor could translate to an additional $200 cost per final product once logistics, labor, and distribution are included. Historical data from 2018 shows consumer electronics experienced price increases of 5 to 15% within weeks after tariffs hit, often outpacing inflation indices. The hidden cost of tariffs is invisible until the consumer feels it directly, whether through higher grocery bills, pricier smartphones, or more expensive appliances. Investors are particularly sensitive to sector-specific impacts. The tech sector is most exposed, given its reliance on semiconductors, rare earth metals, and international manufacturing. Automotive faces assembly line disruptions, while consumer goods retailers must adjust pricing models and inventory strategies. Hedge funds are rotating into safe haven assets like gold, silver, and treasury bonds. ETFs tracking international supply chain sensitive sectors are under pressure. Even companies that thought they were insulated are revising earnings forecasts as tariffs create cascading operational costs. The stock market, while reacting to broader macro conditions, is now processing micro-level shocks. Futures prices for high-exposure sectors fluctuate daily. Hedge funds employing algorithmic trading attempt to anticipate tariff announcements and shipping delays. Volatility indices spike. For many retail investors, the headlines appear abstract, but the effects are real. Companies unable to hedge adequately may face losses, layoffs, or reduced production. Investors must evaluate exposure not just by stock prices, but by supply chain resilience and tariff risk, variables often hidden from public filings. And here's the cliffhanger. How long can companies absorb these escalating costs before they inevitably pass them to consumers? Will stock markets continue to float in a fragile equilibrium, or are we entering a period where panic and forced liquidations dominate trading decisions? The first 4 chapters of Trade War 2.0 demonstrate that tariffs are not just political tools. They are market-moving forces that ripple across the global economy, touching factories, shipping ports, consumer prices, and investor portfolios simultaneously. The shockwaves from Trump's 2026 tariffs are no longer confined to the U.S. alone. They are rippling across the globe, creating a domino effect that could redefine international trade for years to come. China, the world's manufacturing powerhouse, responded immediately. Beijing signaled it would not remain passive, with officials hinting at countermeasures ranging from tariffs on U.S. agricultural exports to restrictions on critical rare earth metals. Factories in Shanghai and Shenzhen started recalibrating supply lines, prioritizing internal consumption and regional exports over American orders. Meanwhile, the European Union issued statements warning of disruptions to its own markets, highlighting vulnerabilities in automotive, tech, and chemical sectors. Companies in Germany, France, and Italy began stress testing operations for sudden cost spikes, anticipating both tariffs and logistical delays. India, a rising manufacturing hub, watched closely. Some sectors hoped to gain by capturing supply chain overflow, while others feared rising commodity costs would exacerbate domestic inflation. Currency markets immediately reflected the geopolitical tension. The Chinese yuan dipped against the dollar, the euro wavered, and emerging market currencies experienced heightened volatility. Investors in Brazil, Indonesia, and South Africa began recalculating debt repayments in dollars, worried about the impact of an unpredictable U.S. trade policy on their economies. Capital flows became unstable as hedge funds reallocated resources away from markets most exposed to tariff-driven shocks. The cliffhanger is unavoidable. Could this trigger a worldwide trade slowdown, pushing not just American companies but entire national economies into a contraction? The interconnectedness of global commerce means that even small tariffs in one sector can cascade across continents, affecting production, employment, and consumer prices in ways that textbooks rarely predict. Companies are now forced to adopt industrial survival tactics. Every executive team is running worst-case scenarios, stockpiling essential raw materials, negotiating multi-country supply lines, and sourcing alternatives where feasible. Electronics giants are diversifying suppliers from Taiwan to Vietnam and India, while automakers are establishing parallel assembly hubs to prevent single points of failure. Retail conglomerates are increasing storage capacity, shifting from lean just-in-time logistics to a buffer-heavy model to absorb delays. Even small and medium enterprises are adjusting, often in secret, to avoid giving competitors a strategic advantage. Some companies are gaining a competitive edge by acting decisively, while others risk bankruptcy due to hesitation or underestimation of tariff effects. This raises the critical question: who will thrive, and who will collapse under the weight of Trade War 2.0? The reality is hitting retail consumers harder every day. Out-of-stock alerts, delayed shipments, and higher prices are becoming the new normal. Electronics like smartphones, laptops, and gaming consoles are taking weeks longer to arrive, while prices quietly creep upward, often in double-digit percentages. Grocery stores are seeing unusual fluctuations in staple goods as import delays affect supply. Clothing, home appliances, and even niche hobby items are disappearing from shelves faster than restock cycles can replenish them. Social media amplifies the perception of scarcity, with users posting images of empty shelves and canceled shipments, triggering a sense of urgency in the broader public. This is no longer an abstract economic theory. It's a lived experience for consumers. The cliffhanger. How long before public panic escalates into actual behavioral shifts, such as hoarding or sudden demand spikes? Investors are closely monitoring every signal. Safe havens and hedges are back in the spotlight, with gold, silver, and certain commodities drawing capital as fear-driven inflows spike. Cash reserves are becoming strategic weapons, enabling investors to buy assets during short-term panic. Commodity prices, especially energy and metals, react not just to actual shortages, but to anticipated scarcity, creating a feedback loop that accelerates volatility. Stocks in sectors heavily exposed to tariffs, electronics, autos, and retail, continue to see sharp rotations, while less exposed sectors like utilities or healthcare show relative stability. The key question: when should investors act before the crash spreads too widely, and how much risk is acceptable in a market driven by both policy uncertainty and real-world supply chain shocks? Timing is everything, and hesitation can turn what seems like a prudent strategy into missed opportunity or outright loss. The conclusion is unavoidable. Trade War 2.0 represents a new normal for global business. It's no longer sufficient to track political statements. Executives, investors, and consumers alike must understand the cascading effects of tariffs, supply chain disruptions, and currency volatility. Global commerce is being rewritten in real time. Every shipment delayed, every price increase, every stock rotation is part of a larger narrative that could redefine market behavior for years. Companies that anticipate change and act decisively will capture market share and mitigate losses. Those that underestimate the systemic impact risk falling behind or collapsing entirely. For investors, the message is urgent. The combination of tariffs, inflation, and supply chain shocks requires vigilance, diversification, and strategic positioning. Commodities, precious metals, cash reserves, and carefully chosen equities form the bedrock of a survival-focused portfolio. Passive observation is no longer viable. Active management, real-time monitoring, and rapid decision-making are essential to navigate the volatility of 2026. And here's the final cliffhanger. Will markets ever recover to pre-tariff stability? Or is this the opening chapter of a prolonged upheaval that redefines global trade, investment, and consumer behavior for years to come? The answer remains uncertain, but one fact is clear. Every business, every investor, and every consumer must adapt, or risk being caught on the wrong side of history. Trade War 2.0 isn't a temporary storm. It's a tectonic shift, and those who ignore it do so at their peril.